Hello and welcome. Wishing you a very good afternoon, dear students. And we start with the third day, part 3 of time value of money. In the first two sessions, which we had on 11th and 13th of July, we have covered a lot of new concepts. First of all, we understood what is time value of money. We looked at why interest is paid. And then we saw two types of interest, simple interest and compound interest. In case of simple interest, yes, the formula is also very simple. In case of compound interest, a little bit complex, but still, I think all of you have understood. And we have also done number of numericals on compound interest. Then we looked at something which is called the effective rate of interest, also known as the equivalent rate of interest, which you are going to earn over a period of time, especially when there is a system of compounding. On the second day, that is the day before yesterday, we covered the important concepts of annuity, which is a series of payments or a series of receipts over a period of time, and two things have to be satisfied. First is, in case of annuity, the same amount of money is paid monthly or yearly or received monthly or yearly. And secondly, the time gap or the time duration between two successive payments or between two successive receipts should be identical, should be equal, should be the same. We also looked at future value. 100 rupees rate of interest, 1000 rupees say rate of interest is 5%. At the end of 1 year, you get 50 rupees as interest. And therefore, your amount or the accumulated balance becomes 1050. This is like the future value. In case of compounding, so we saw this formula that the amount is equal to principal into 1 plus I to the power n. And when we have something like annuities, right? So we say future value is equal to cash flow into 1 plus I to the power n. Therefore, the present value is equal to the future value divided by 1 plus I to the power n, where I is the rate of interest and n, you know, is the number of conversion period, right? And today, being the last day of this particular chapter, time value of money, we shall be covering many of the examples in the exercises, especially exercise 4B. Number of numericals I will be solving. I request you to keep pen and paper ready with you, calculator ready with you, so that we can work together, we can complete our understanding. And specifically, today's session will be on the applications of the time value of money. In the last two sessions, I had told you that this chapter is considered to be one of the most important, as a chartered accountant would realize, because in every area of finance, in every area of financial management, management accounting, and decision making, we use this particular chapter. So the first application we shall be learning today is whether to go for purchasing a machine or whether to take it on lease. So leasing decision versus buying decision. The second thing we shall be covering is something which is called the compounded annual growth rate, also known as CAGR. And we will look at bond valuation, how to find out the value of a bond. As you are aware, dear friends, there are different types of financial instruments. You have read about equity shares, preference shares, which are also called equity share capital, preference share capital, and there is something called bond or debentures. Now these bond and debentures are actually disclosed as borrowings in the balance sheet on the liability side of the balance sheet, and bond is a financial instrument through which I purchase bonds in a company for a specified period and I get interest at a predetermined rate. So if it is 6% or 7%, that's a fixed rate of interest. But then the question comes that I'll be receiving payments over a period of time in the form of interest on the bond. But what should be the purchase price of the bond so that I ultimately become a gainer? I gain and I don't lose out. So that is all about bond valuation, a very interesting part. And dear friends, you will also learn about bond valuation in your IPCC and your final as well. So it's a very important chapter. And we shall also look at capital expenditure decisions. You know, in a company, in any entity, there are two types of expenditure: revenue expenditure and capital expenditure. What is revenue expenditure? When you purchase raw materials, when you pay salaries, when you pay for the overheads, when you are paying for rent, taxes. So these are recurring, these are annual expenses, right? For day-to-day handling of the business, for day-to-day running of the business, for day-to-day operations. But what is capital expenditure? It is also called capex, right? It's called capex, right? Capital expenditure in brief, capex. Now in case of capex, we have to decide whether the capex ultimately will provide us benefit over a period of time. Because if you invest money in a machine, if you buy a machine, it is supposed to provide you with cash flows. You are going to earn something from it. So we have to see whether the machine, the purchasing of the machine is going to be profitable in the long run, whether it's going to provide us with benefits, whether it's going to yield some benefits, right? So that is what we learn in the capex part, the capital expenditure part, right? We shall also do a number of problems from the study material, the additional question bank, and also from past years' questions which have come in CA Foundation. So a quick recap of some of the key concepts we have covered in day 1 and day 2. First day, if you see, you please refer to the notes. I'm sure you have gone through the presentations which has been uploaded by the institute, and you have gone through the videos. Many of you are logged in and you are watching this program live. So I'm sure you have the notes in front of you. First and foremost is the time value of money. So you know that time value of money states that money received in future is less valuable than money received today. Why? Because if I receive money today, then I can invest it somewhere. If I invest it somewhere, I shall be able to earn some interest, some returns. You know, returns can be in the form of dividends. Return can be in the form of any sort of interest. It can be in the form of income, any sort of income. So I'm going to earn something, right? That is the reason why money received today is better than money which I'm going to receive tomorrow. In other words, money received today provides me an opportunity to earn some returns on it. Therefore, it is preferable than receiving money in future. So if someone tells me, well, I want to give you 10,000 rupees. Do you want it today, now, or do you want it after 6 months? The amount is same, 10,000, whether I receive it today or whether I receive it after 6 months. But there's a difference of time. Today and 6 months means if I get the money today, I can invest it for 6 months in some business, in a bank, in mutual funds, in bonds, in shares, somewhere. So I'm going to earn return on it. That means the amount I'll be having after 6 months will be 10,000 rupees, the principal, plus the return I'm going to earn, the income I'm going to fetch on this investment, right? So time value of money always states that money which is received today at present is always better than the same amount of money which you'll be receiving later in time. So that is the first point. Now we also talked about, on the second day, we spoke about number of shortcuts. Quick recap, you may remember that I spoke about very important shortcuts which are there in calculation of compound interest and simple interest. So we had for 2 years, we had for 3 years. For 2 years, you may remember, The formula was P into I square, where P is the principal amount and I is the interest. Okay? It must be there in your notes. Please go through it. And in case of 3 years, the difference between the compound interest which I'll be earning in 3 years' time minus less the simple interest I'm going to earn, that is the differential between the two interests, right, for 3 years is 3 pi square plus pi cube. So these are the two shortcuts we did, and we will do numericals on these two shortcuts today. Next we did the rule of course, the rule of 72, 114 and 144. You remember that I said that this is based out of compounding. Now if you want to know in how many years, if the interest rate is say 6%, in how many years my money will become double through compounding. It's an approximate rule. It does not give you the exact answer, but yes, for quick calculations, it does give you a thumb rule. So if my interest rate is 6%, compounded annually, and I have a sum of money, right, say 10,000 rupees, 1 lakh rupees, whatever, in how many years can I double the investment? In how many years will the principal be 2 times? It is 72 by 6, that is 12 years. And in how many years my money can become triple, that is 3 times. Then what we do, 114 by 6, right? And in how many years the money will become quadruple, that is 4 times. It is given by 144 divided by, in this case, 6%, because we have taken 6. So 144 divided by 6, this will give you the number of years after which the money will become 4 times. So we talked about 2 times, 3 times and 4 times. Okay, now we have received some excellent queries from our friends who have gone through, who have been part of the last day's session. So I'll be taking few questions and I'll be responding to them. Okay, the first is from Vaibhav Upadhyay. He has asked the question, what is the difference between leasing and renting? Lease and rent. Now today we shall be doing a very important part, and that is leasing decisions. So you need to have good idea of what is lease, right? Now if you talk about lease, you have heard this term many times. Leasing of land, leasing of a car. So what is the difference between lease and rent? So Vaibhav Upadhyay has asked this question. So the key difference between lease and rent is that both are almost the same, but in case of lease, what happens? The period of lease, the period of lease is always stated in the agreement. If you see a lease agreement, you will find that the period is stated. In case of rent, the period of rent may not always be stated in the agreement. So may not. Okay. The second is, normally in case of lease, see, in case of lease, we generally talk about leasing of equipments, leasing of assets, leasing of land. And normally the lease period, right, is much longer than rent. I might take maybe an apartment on rent for a few months, but when it is lease, it could go up to 10 years, 20 years, 30 years, even 99 years. So the period is longer, is usually longer. And the third difference, if you see, is that leasing is normally done for assets, right? Assets. It is done for equipments, assets and equipments. For example, you will see that infrastructure companies, infrastructure sector, building, right, engineering sector, lot of items, lot of equipments are leased out. Okay, so many of the companies which are engaged in the field of construction, real estate, okay, hardcore engineering, heavy engineering, they use lot of leased equipments. They use a lot of leased assets. For example, the pickup truck, the crane which they use. Okay, different type of building equipments. These are often leased equipments. So normally assets are given on lease and equipments are given on lease. On the other hand, rent, if you see, is mostly for properties. We always say that yes, he has purchased a rent, he has obtained a rented property. Okay. Similarly, you must have heard the term leasehold land. So when it is land, we don't use the term rent. I don't say that I am, getting a piece of land on rent, but we always use the term we are getting a land lease. And the land lease gives me the right to use the land for the given period of time. It can be 1 year, it can be 10 years, it can be 99 years. Okay, ultra long leasing period. So lease, in case of lease, the period is stated. In case of rent, it may not be explicitly stated in the agreement. Second is, in case of lease, the normal leasing period is longer, the duration is longer, and in case of lease, normally assets and equipments are taken on lease, whereas in case of rent, we normally consider properties on rent. Now, please also remember that rent, when it comes to lease, there are certain accounting standards. AS 19, I mentioned on the last day, accounting standard 19 deals with lease, and we have another standard, Ind AS 116 deals with lease, right? So this is the difference between lease and rent. Some of you have asked questions like Vaibhav regarding what is the difference between lease and rent. Essentially the same, but lease is more of a technical term, right? And you can see the differences which I explained right now. Second question has come from Srajal Gupta from Kolkata. Now the question is, please explain opportunity cost. Once again, I'm explaining. Some other friends throughout the country and from outside the country also have requested me to explain opportunity cost. Okay, now think of this situation. I was working in a company, I left the job, and I have now started my practice as a chartered accountant. You know, as a CA, you can work in a company, you can also start your practice, right? You can also float your own consulting company. There are numerous opportunities for a chartered accountant in every industry, in both industry as well as in practice. You can work as a consultant, you can work as a partner in a firm. Now say I was working in a company and I was getting a salary, say, of 1 lakh rupees per month. I left my job and I started my practice. Starting practice, dear friends, is more like starting your own business because you don't know whether clients will come. So in the first month, I just sit in my office, right? No work to do, going through studying, updating myself, looking at the time, oh, when will clients come to me? Right? I wait and wait and wait. Now, definitely I am doing practice not for charity, but it's my profession. I want to earn. But question is, I have a cost here. The cost is my opportunity cost. What is my opportunity cost? In this case, the opportunity cost is the salary which I was earning or the salary which I can earn if I go back to jobs, if I go back to the industry, if I take up a job once again. So if I was getting a salary of 1 lakh rupees per month, that 1 lakh rupees is my opportunity cost in my profession. In other words, I must earn more than 1 lakh rupees a month from my practice, from my profession to justify the step which I have taken, that is leaving my job and starting my practice. I hope, Strajal, you are now clear with opportunity cost. Opportunity cost means the cost of opportunity which is given up, which is foregone, which is sacrificed, right? In case of job, I give up my job. You cannot, ride two boats together. Either you are in job or you are in practice. So I gave up my job to come into practice. Fine, I was getting 1 lakh rupees per month in my job, and if I join today in some company, I will be getting 1 lakh rupees per month. Say, we are assuming, okay? So my opportunity cost is 1 lakh rupees, and I must earn more than that, right? Fine. I go next to Anupam Arora's question. He has raised a beautiful question that what is the formula of compound interest. If you want to find compound interest only, not the principal, not the amount, then what is the formula? So it's good that many of our friends like Vaibhav and Srajal and Anupam, they are raising these questions. Good. It shows you are attentive in the session. You are going through and you may have doubts. So I'm always there. Get back to me and I'm trying to provide answers to your query. Right. And I'm sure the more we discuss, the more we interact, the more we, analyze, the better will be your understanding. Okay. Now, question which Anupam has raised is what is the formula for interest? We know in case of compound interest, the accumulated balance or the amount is equal to P, which is the principal, into 1 plus I to the power n. So we know that this is basically the formula for amount. Okay? But I want to find out the interest. As Anupam has said, so what is the formula to get the compound interest only? You know that this A amount is nothing but principal plus interest. Right? So I can say that this part is what is my amount. So from this formula, amount is equal to principal plus interest, I can write interest, only this part, only the interest part is equal to amount minus principal. And the amount is here, P into 1 plus I to the power n. This is the amount. This minus P comes, minus P. Okay, so this is the formula for the interest. I discussed it in the last day. Once again, Anupam, I hope now you are clear. Amount is equal to principal plus interest. So interest is equal to amount minus principal, right? And we have seen the amount is this, principal into 1 plus I to the power n. This is the amount. And we need to find out the interest. So I deduct the principal. This minus P comes here. So this gives you the formula of the compound interest, right? The next one is from Jay Pathak from Satna. Jay has asked a very interesting question. Sir, what is liquidity? It's good that we are able to revise many of the concepts because today is the last part 3 of time value of money, and we should make sure that we understand all the concepts. Right. Now, Jay has asked what is liquidity? Jay, I answered this in the last session also. I explained it. Liquidity means something which is in the form of readily available cash. Now say in the balance sheet, let me go here once again. Okay. So in the balance sheet, you must have seen, let me put it in this way, the asset side, and I go to the current asset. Current asset. In current asset, what is there? What are the items which are there in current asset? So you have trade receivable, okay? Then you have inventory, okay? Right? And you also have cash in hand, cash at bank. Okay. So these are the normal items which are usually there under current asset. If you see, if I ask you which item out of these 3 items is the most liquid item, the most liquid item. Okay. So I would put it in this way. I have just written it in a haphazard manner. Now let us see which is the most liquid item. Cash is the most liquid item. So liquidity means something which is in the form of cash, or cash equivalent. Say I have got few checks, demand draft. These are not in the form of hard currency, but this can be readily converted into cash equivalents, right? So these are more in the nature of cash equivalents. I might be having certain customers' checks. I have sold goods. The customers have paid by check, by demand draft. So the instrument, demand draft, you know, is an instrument. Check is a negotiable instrument. You have read about Negotiable Instruments Act, right? So these are not in the form of hard cash, but these are cash equivalent because this can be readily converted into cash within a single day. A very short time is required to convert them into cash. So the most liquid item is cash in hand and cash at bank. Then of course the next is trade receivable. Why? Because sundry debtors are ready to pay. The moment credit period is over, they shall pay, and I can get back the payment, and the payment will be in liquid form. And the least liquid is inventory, because inventory has to be sold. So inventory will first become trade receivable, then it will come to cash. So the most liquid item is cash in hand, cash at bank, and the least liquid item out of the three items here is inventory. Okay, so this is what is meant by liquidity. I think now you understand something which can be readily turned into cash within a short span of time. And why we pay interest? Because interest component also includes something which we need to compensate to the lender, because he has given me money. I must pay him back through the process of paying interest, and it should be in the nature of liquid. So it provides additional liquidity, right? So it's a liquid payment, more in the form of cash, right? If I transfer fund in your account, it's a payment, it's a direct payment. So you get in terms of cash, you can immediately withdraw the money. Okay? But if I pay you by draft, it is a cash equivalent. You cannot directly convert it within a single, you need some time to convert that into cash. But if I send you a direct cash payment, a direct fund transfer, then it means a payment using liquid means, highly liquid payment. Okay, so you can see liquidity status, liquidity, the type of liquidity of these three items. Most liquid is cash in hand, cash at bank, and the least liquid is inventory. I hope, Jay, you are now clear and others are clear. Nazbeen Khan from Mumbai has asked the question that, sir, what is the formula for the difference of simple interest and compound interest when it comes to 4 years? Now, we have just seen the formula for 2 years. You saw it is for 2 years, it is pi square. Okay. So that when it comes to 3 years, we saw that it is 3pi square plus pi cube. So 3 into pi square plus pi cube. Now, what happens when the number of years go to 4? The question is, very few, I think, problems will come where 4 years are involved. Mostly the questions which have come, if you look at the model test paper, if you look at the past year's questions which have come in the CA Foundation exam, mostly the questions are coming and they're asking you to find out the difference of the compound interest and simple interest for 2 years or 3 years, but definitely for 4 years, the formula is P into 1 plus I to the power 4, because here 4 years, so P plus I to the power n is 4 minus 4 pi. Okay, so this is the formula for the difference between the compound interest and the simple interest when the period is 4 years, right? I hope, Nazbeen, you have got your answer. Now, a small clarification I want to give, because two of our friends have asked a question on Kramer's rule. I'll just spend little time on the clarification. Few of our friends, namely Palak Agarwal from West Bengal and Gokula Selvan from Chennai, has asked the question that, sir, can you give an example of a simultaneous equation which gives inconsistent results? Just a moment, because I need to clarify this, because we have already done Kramer's rule. Just one answer to this and then we shall proceed. Now, friends, you know that equations we have done, most of the solutions we have done were in the form of simultaneous equations, quadratic equations. We also solved equations using Kramer's rule. Now, what happens when I give you the two equations? Let's call it 3x minus 2y equal to 4. And I give you 6x minus 4y equal to, say, 0. So the equations are 3x minus 2y is 4 and 6x minus 4y is 0. Are they consistent? So the question was on inconsistent. Both Palak and Gokula Selvan are from Chennai asked, Sir, can you give a situation where we are going to get inconsistent solution? Right. Now, first of all, if you find out the determinant of this particular, two equations, what happens? You get 3, minus 2, 6 and minus 4. So if you see, determinant means 3 into minus 4, that is minus 12. Minus 6 into minus 2, that is minus of minus 12. So you get minus 12 plus 12. Minus 12 plus 12, which is 0. So determinant becomes 0. Determinant becomes 0. Plus, now if you just try to, so first observation, in case of inconsistent solutions, inconsistent equations, you will get this, the determinant will be equal to 0. Now, if you see what happens next. Now, if you just multiply equation 1 by with 2, so multiplying equation 1 by 2. Okay, let's try with minus 2, because my objective is to get minus 4. So let us multiply by minus 2. Okay, I want to get plus 4y, so that I can cancel this plus 4y with this minus 4y. So minus 2y is already there. If I multiply minus 2y by minus 2, I shall get plus 4. So multiplying equation 1 by minus 2, I get minus 2 into 3, that is minus 6x. So I get minus 6x. Minus 2 into minus 2, that is plus 4y. And this is equal to 4 into minus 2, right hand side. 4 into minus 2, that is minus 8. And please see the next equation, 6x minus 4y. So minus 4y is equal to 0. So if you now see the fun here, if you now add these two, what do you get? You get minus 6x, right? And plus 6x, which is 0. And plus 4y, minus 4y is 0. But on this side you get minus 8 plus 0 is minus 8. That means 0 is equal to minus 8. Is it possible? No, it's not possible. So it is a false equation, false statement. So this system of equation will have no solution, and this is an example of inconsistent equations. Okay, now we come back. So I think both Palak and Gokula Selvan are from Chennai. I think you have got your answer. Now we come to simple equation quickly, and we see simple equation. So you remember, it's a recap, quick recap of what we have done in the last 2 days, and then we will smoothly flow into the applications of time value of money. Okay, so we saw the simple equation. So once again, amount is equal to P into I into T, where P is the principal, I is the rate of interest, and T is the time. We also saw the compound interest. Once again, I am writing the formula. Amount is equal to P into 1 plus I to the power n, which means that if you want to find out only the compound interest, like I did little while back, then the interest will become P into 1 plus I to the power n minus P. Right. So these two formula we have done. Now we do a very interesting question from the study material, page number 4.16. So let's go to page 4.16, example number 21. Many of you in the query box have requested me to take up this question. I have two of their names, Mayank Prajapari and Roshni Bedwal from Delhi. It's a very important question for your exams, and it is example 21, page 4.16 of your study material, ICAI study material. Please open the question. You will see the question is, a person opened an account on April 2011 with a deposit of rupees 800. So April 2011, the person opens an account with rupees 800. Fine. The account paid 6% interest, which is compounded quarterly. So it is 6% interest and it is compounded quarterly. Quarterly means, you know, How many quarters are there in a year? We have 4 quarters, right? So every quarter the compounding of the interest is done, right? Now on October 1st, the question reads, on October 1st, 2011, so on October 1st, 2011, he closed the account and added enough additional money to invest in a 6-month time deposit for 1,000 rupees. So whatever money he had, he added some more money. Okay? So whatever money he got from here, he added some more money. I'm writing add. He added some more money and he got 1,000 rupees. Right? This 1,000 rupees he is investing in a 6-month time deposit. 6-month time deposit, and he is getting 6% interest compounded monthly. So from April, this is from October. From October 1st, 2011, 6 months means October, November, December, January, February, March 31st. That is basically 1st April, you can say 31st March. For 6 months, he is putting it in a time deposit and he is earning how much interest? He is earning 6% interest compounded monthly. Be very careful. This was quarterly compounding, but this is monthly compounding. So over the 6 months, he is getting 6% interest, but the compounding has now become monthly. So I'm writing monthly. Okay. Now, first question, let us go question by question, part by part. The first question is, how much additional money did the person invest on 1st October? So once again, let us understand the question. Thanks to Mayank and Roshni for requesting me to do this question once again. So April, he started his transaction. He started with an amount of a principal amount of 800 rupees. He invested the money and he was getting interest of 6% compounded quarterly. On 1st of October, he closed the account and he put in some more money from his pocket, got 1,000 rupees and invested the 1,000 rupees for 6 months in a time deposit account where he got 6% interest on a monthly compounding. Okay? So we have to find out what is this amount. Now, first of all, let's go to the solution. Now, please note that he was getting 6% quarterly compounding. 6% per annum. Okay? 6% per annum he was getting, but on a quarterly compounding, which means that 6% means 0.06. Right? I think I explained this in the last class, how we are getting 0.06. But now, this is for 1 full year. But we have quarterly compounding. So in 1 quarter, for 1 quarter, the interest becomes 0.06 by 4 because there are 4 quarters. Okay? So the yearly annual interest rate by 4 gives you 0.015. Therefore, he started with 800 rupees, right? And quarterly compounding, the duration was 6 months. So what is the amount he got? The formula you know is P into 1 plus I to the power n, this part. So, principal is 800, so I write 800 here into 1 plus. I is 0.015, so 0.015 and n is how much? Quarterly compounding. And the duration of the investment is 6 months. In 6 months, there are 2 quarters. So n is the number of conversion period and that is 2. So n is equal to 2. So the formula is 800 into 1 plus 0.015 to the power 2. If you find it out, if you break it up, you get, it's already given in the numerical. The value is given 1.3022500. So you get, the amount becomes 800 into 1.03022500. So you are getting 824.18. That means on 1st October, he received rupees 824.18. He had how much? He had 800 rupees. He receives 824.18. Right? So this is the first part, because the question was how much additional money he has put in. Now on 1st of October, this is the amount he got from the old account, from his first account. He closed the account and he put in some more money, and after putting the more money, after putting some additional money from his pocket, he got 1000 rupees. Therefore, the question is, what is the additional money he put in? Very easy. He had received 824.18 and now he has 1000 rupees after putting some money from his pocket. So what is the additional money which he brought from his pocket? Simple. 1000 minus 824.18. This is the additional amount of money which he brought, and that comes to rupees 175.82. Okay, so we have done the first part. 175.82 is the additional amount of money which he brought from his own source of fund, added the amount to 824.18, got 1000 rupees, and on 1st October opened a new account which was a time deposit account for 6 months with that 1000 rupees. I hope it is clear as crystal, right? Now this was the first part. The second part is, please see the question. What was the maturity value of his time deposit on 1st April 2012? Okay, so I'm rubbing this part. We go to the next part. First part, we have done two things. We saw that this 800 rupees ultimately gave him 824.28. So with 824 he started with 800, he got 824.28, then he put in some more money, 175.82. So he got altogether 1000 rupees. And this 1000 rupees he is putting in a time deposit for 6 months. That means from October, November, December, January, February and March, 31st of March. We have to find out what is the amount he receives on 1st of April 2012. That is after the end of the six months. Dear friends, let's do another calculation here. So we are doing example 21, page 4.16, the second part, part B. So he started with 1000 rupees on October 1st. Fine? Clear? Right. Interest rate, please see the numerical once again. It was 6% per annum, but the compounding is done monthly. Okay. So if you do a monthly compounding of 6%, 6% means 0.06. But if you want to do a monthly compounding, then the monthly interest is how much? In 1 year, how many months do we have? 12 months. So if this is the annual interest, I want to find out the monthly interest. So I divide it by 12, I get 0.005. Okay, 0.005. Okay. So now we know that the monthly interest I is equal to 0.005. Great. One part is solved. Now the question is, the formula we know. Formula is simple. P into 1 plus I to the power n. Here P is 1000. Very good. I put 1000. Into 1 plus I is 0.005. So I put 0.005. But what is n? Any idea? Any guesses? So n is the number of conversion period. Now here we are having monthly compounding, but what is the duration of the investment? Please see the numerical. Once again, it is clearly mentioned that he put his money in a 6-month time deposit. So the duration is 6 months and we have monthly compounding. So how many times the conversion takes place? 6 times. 6 months, monthly compounding. So n equal to 6. So 1000 into 1 plus 0.005 to the power 6. Okay. If you solve it out, the value is given. This part, the value is given in the problem. it is coming to 1.03037751. Please check it in the study material. So if you multiply that 1000, this 1000 multiplied by 1.3037751, you are getting 1030.38. So he started with how much? He started with 1000 rupees. He receives 1030.38. So we come to the last part of the question. I think this part B is simple. I hope you have understood it. This is a critical example and a very, very important problem, because in the exam, these type of problems come often, which tests your knowledge of compounding. And you can see there are two types of compounding mentioned in the problem. In the first part of the problem, we referred to quarterly compounding, and in the second part, we are referring to monthly compounding. Okay, so therefore 1030.38, you can see what is the interest he has earned. He started with 1000. He received 1030.38. So what is the additional amount he has earned? 1030.38 minus 1000. So he earned 30.38. But in the first round of his investment, he had received 824 and his principal was 800. So here he had earned 24.18. Right? Please see. He started with 800. On 1st October, he got 824.18, which means the interest he earned was 824.18 minus 800, which gives you 24.18. And now he gets an interest 30.38. So the total interest which he has earned is how much? 24.18 plus 30.38. That gives you 54.56. 54.56. So this is part C. Because in the third part, in the numerical, the question is, what is the total interest he has earned? Right? So once again, we saw this problem. We first found out the principal amount was 800 rupees. He kept his money for 6 months and there was a quarterly compounding. So we found out what is the quarterly interest. From there, we found out that the conversion period is 2, right? Because every quarter the compounding is done. The duration was 6 months. So N was 2. So we use the formula P, that is 800 into 1 plus I to the power 2, right? We put in the value of interest I and then to the power 2, we got 824.18. So the differential amount, he started with 800, but he received 824.18, which means the difference is what? The interest. The interest is 24.18. Correct. Next, with that money, 824.18, he put in some more money from his pocket and he got a corpus of 1000 rupees. So 1000 minus 824 gives you 175.82. This was the additional amount of money which he invested from his own funds. He got 1000 rupees, put it into a 6-month time deposit where he was getting 6% interest on a monthly compounding. So we found out the monthly interest, which was 0.005, and we also found out that the compounding period, the conversion period is 6, N equals 6. So the formula was 1000 into 1 plus 0.005 to the power 6. We got 1030.38. He started with 1000, he got 1030.38. The difference is nothing but the interest which he got, and the difference is 30.38. So this is the interest he received on 31st of March, and 24.18 was the interest he received on 1st of October. If you add it up, he is getting a total interest of 54.56. Right? I hope this is clear and you are relaxed when it comes to the solution. You are clear, you have got your clarification, and this also adds to your knowledge. Okay, now we are going into another example which I did last day, but it is once again being done because we have some requests. and this is example 23 of page number 4.19. Okay, so page 4.19 and the example is 23. Okay, we have two requests coming in. Sumanita Panchangam from Chittor and Nishita Chaudhary from Andhra Pradesh. They have requested me to do the problem once again. I did it last day. Once I do it, you will remember that we did it last day. Once again, I am doing it. Now, the question is, if you see example 23, page 4.19 of the study material, find the amount of compound interest and the effective rate of interest if an amount of 20,000 is deposited in a bank for 1 year at the rate of 8% per annum, compounded semi-annually. So the principal amount is 20,000. Fine. We have to find out the CI and the effective rate of interest. This we don't know. Okay. It is deposited in a bank for 1 year. The duration is 1 year. Fine. And the rate of interest is 8%. So I is 8%, which is 0.08 per annum in 1 year. And the compounding is done semi-annually. That means the compounding is done in every 6 months. Semi-annual compounding. Okay. So compounding is done semi-annually. We have to find out what is the amount of compound interest. Okay. First of all, let us find out. You know that I was writing here, interest is equal to amount minus principal, and the amount is P into 1 plus I to the power n minus P. This will give you the compound interest. Okay. Right. So if you just work out like this, you will be getting semi-annual, we have to find semi-annual compounding. Interest rate is given. Now, if you see the interest rate is 8%, that is 0.08 for 1 year. So for semi-annual, that is for 6 months, the interest will be 0.08 by 2, that is 0.04. Fine. Semi-annual and the duration is 1 year. Compounding is done semi-annually and the duration is 1 year. That means how many conversion period? 1 year means 12 months. And the compounding is done every 6 months. Why? Because semi-annually means once every 6 months. Semi-annual, half of a year. Okay? So 12 by 6 gives you 2. So n is equal to 2. Right? So the formula, if you see, is P is how much? 20,000. 20,000 into 1 plus I. I is 0.04. 0.04 to the power square. This is the amount minus 20,000. Right? Because 20,000 is the principal. We want to find out the interest, the compound interest. So this gives me, if you work out, you will find that it gives you 1,632. First part is done. The second part is even simple, is simpler. The question is, what is the effective rate of interest? Effective rate of interest. So we have done the compound interest part. CI is done. Simplifying this, you will get 1 plus 1.04 into 1.04 if you work out, right? And you can easily get this, right? Now, coming to the second one, effective rate of interest. You know the formula for effective rate of interest is how much? What is the formula? 1 plus I to the power n minus 1. Right? That is the formula. We have done it last day. If you put in the values in this formula, right, you get 1 plus I. I is how much? 0.04. So 1 plus 0.04. N is 2. So 2 to the power 2 minus 1. That is 1.04 square minus 1. If you simplify this, it comes to 0.0816. 0.0816. 0.0816 means how much? It means 0.0816 into 100%. So it actually means 8.16%. Okay? So in this problem, this is again from the study material. We did it last day. Once again, I did it today because of the requests. I hope it is now clear and you're absolutely confident about how we solved it. There's simple process involved. Step by step, I'm explaining. We started with 20,000 rupees. That is the principal amount. Interest is 8% for 1 year, but it's a case of semi-annual compounding. So the interest for 6 months becomes 0.04, which is half of 0.08. And the conversion period is 12 by 6, that is 2. So we put in the value of I equal to 0.04 and N equal to 2 in the formula, and we got the interest. The compound interest is 1,632. Second is the effective rate of interest. All of you know the formula. 1 plus I to the power n minus 1, and putting the value of I and n, we have been able to find out that it boils down to 0.0816, which is nothing but 8.16%. So the effective rate of interest which this amount of money fetches is 8.16%. Right. Friends, when it comes to effective rate of interest, there are two important observations. First observation is, if interest is compounded, please think, if the interest is compounded annually, then the effective interest rate for the year will be equal to the actual interest rate which is offered per year. So, I'm rubbing this part and let us note these two observations. So, we have done this example as well. I hope you are clear. Right. So, when it comes to the effective rate of interest, first observation is, if the interest is compounded annually, so for annual compounding, the effective interest rate, the ERI, will be equal to the actual interest rate. Okay, to the actual interest rate if the compounding is done annually. But if we compound the interest more than once a year, okay, if the period is 1 year, then this is correct. But if the compounding of the interest is done more than more than once a year, then what happens? Then the effective rate of interest will be more than the actual rate of interest. So in the second case, the effective rate of interest will be more than the actual rate of interest per annum the moment the compounding of interest is done more than once a year. Okay, so when the compounding of interest is done more than once a year, right, so N increases, the conversion period increases, automatically the effective rate of interest will be greater than the actual interest which you will be earning per annum. So these are two important observations. Right. Now we move on to the annuity quickly, and you remember we discussed about two types of annuities. First was the annuity regular, where the payment is made, the cash flows, either cash inflow or the cash outflow takes place at the end of the period. That is annuity regular, right? So we had annuity you are clear. It means a fixed payment, either receiving or paying, right? Fixed payment, either receiving or paying, and the difference, the time gap between two successive payments should be same. The time gap between two successive payments should be identical, should be equal. That is what is called an annuity. There are two types of annuity. First is the regular annuity, right? And the other one is what is called annuity due or annuity immediate. So it is called annuity due. So I'm writing due or immediate. Okay. Now in case of annuity regular, you know that the interest is paid at the end of the year or the end of the period. But in case of annuity due or annuity regular, you know that it is received at the beginning of the period. Okay. And we remember, you might be thinking that yes, we have done it last day. Yes, we did it last day. You must be getting, you must be finding the notes in your study material as well as in your scratch pad, in your scrapbook, which you are probably maintaining as we move ahead in the lecture. So the formula you must be remembering, please refer to your study notes. Regular, for regular cases, that is for annuity regular. What is the formula? ANI. This gives you A into 1 plus I to the power n minus 1 by I. We did it last day, and for the annuity due or the annuity immediate, the formula is A 1 plus I to the power n minus 1 by I into 1 plus I. These are the two formula which we did last day, and I also referred to the part of the study material is 4.6.1, and we did the formula, and let us now do something of some numericals. And before that, of course, I also referred to sinking fund. We did sinking fund. You may remember last day we completed sinking fund. Sinking fund I explained. Sinking fund is a mechanism by which we transfer fixed amount of money every year or every quarter or every month to a fund, right, for the purpose of, say for example, purchasing a new asset, for repairing a new asset, repairing an existing asset. It could be used for maintaining an asset. An asset, I gave an example, it could be a plant and machinery item, it could be an apartment. Even in the apartment you stay, there is always a sinking fund where the apartment owners transfer fund on a periodical basis to create a corpus, to create a sinking fund, which will be used for the purpose of painting or replenishing the any of the assets, or for the purpose of repair, operation and maintenance. Right. So that is what is called sinking fund. Okay. So let's now take a few examples. So we are through with, we have discussed once again, we have discussed the time value of money. We saw in depth some numericals from the study material on compound interest, right? And we also did the effective rate of interest once again, ERI. And now we have looked at the annuity once again, annuity regular and annuity due or immediate. Now let us do a small numerical. This is an additional question which has come in the exam in CA Foundation in the earlier years. Okay, I'll do the numerical and let us work together. The question is, 10,000 rupees is paid every year for 10 years. 10,000 rupees is paid every year for 10 years. Every year 10,000 rupees is paid to pay off a loan. Okay, so this is the installment. The annual installment on a loan is 10,000 rupees. What is the loan amount? If the interest rate is 14%, so interest rate I is equal to 14%. I is 14% and it is compounded annually. Compounding is done on an annual basis, once a year. Okay, so the compounding I am writing is annual compounding. 10,000 rupees paid every year to repay a loan. And what is the loan amount we have to find out? If the interest rate is 14% and the compounding is done once, that is annual compounding. The problem also gives you P10. So they have given the value, so it will reduce your workload. P10 into P10 comma 0.14 is equal to 5.21611. So this is given in the problem. In most of the numericals in the exam also, the problems, in many of the problems you will find that the value, this compounding factor value will be given. So your calculation, you don't have to do so much of calculation. You just have to use your concept, you have to use your knowledge, apply your common sense, apply your understanding and solve the problem, because this calculation you don't have to do it, because in most cases it will be given in the exam. Right. So let us see here what to do. So here n is equal to, we can see n is equal to 10 because we have annual compounding. So first of all, n is equal to 10. Number of conversion period is 10 because we have annual compounding and the duration given is 10 years first. Second is, what is the interest rate? Now the interest rate I is equal to 0.14. We don't have to adjust the interest rate because it is annual compounding clearly mentioned. Okay. So if you require to find it out, simple, what is going to be the 10,000 is paid every year, right? Every year. So what will be the value of the loan? What is the loan amount? So the loan amount L is simply equal to the installments paid into, this is the principal amount, okay, into the factor, the compounding factor, CF. Now the compounding factor is given 5.21611. So it is just 10,000 into the value given 5.21611. So you are getting rupees 52,161.10. Okay, as simple as that. So just multiplying the compounding factor by the principal, with the principal, right? So this is basically what is called the process of solving problems where the compounding factor is given. So you don't have to work on it. Okay. Another example I'll work upon, that is similar example, but there is some complication. Now, Ram bought a scooter costing 73,000. So he is buying a scooter costing 73,000, fine, and he is making a down payment. Down payment is 3,000. Okay, so the scooter costs 73,000 and he is making a down payment of 3,000. Please note, this is an additional question. Okay, now he agrees to pay 3,000 is down payment and the balance he is paying over a period of 4 years. So 4 years he is paying like an EMI. In case of EMI, it's a monthly payment. This is an annual payment. So now you have to find out what will be the annual payment. How much he has to pay every year so that he can pay the entire amount of loan. And you can see here the down payment is 3,000 rupees. The cost of the scooter is 73,000, which means the loan amount ultimately is how much? 73,000 minus 3,000. 73,000 is the cost minus the down payment is 3,000. So the loan is 70,000. Fine. He is repaying this 70,000 in 4 years. He is repaying this 70,000 in 4 years and the interest rate is given. The interest rate is how much? 14% and compounding annually. So I is 14%, that is 0.14. 0.14 and the compounding is annual. Okay. Please also note, to make it very simple for you, right? To make it easy for you, the point is that to make matters manageable for you, right, the compounding factor is given. So P for 0.14, the value is given 2.91371. The value is given, right? So you can understand, if you put in the formula, we know that in this case the down payment is 3,000. We have to find out every year what will be the cash flow. So you know that ultimately the future value, right? The future value is cash flow into 1 plus I to the power n, right? And in this case, you have to find out the cash flow. So cash flow is equal to the future value divided by 1 plus I to the power n. This is the formula we use. Now in this case, he is making equal payments, right? It is like a sinking fund. Or you can call it, it is like an annuity. He is making payments. In case of annuity, you know that there is annuity regular and you know annuity due. In case of annuity regular, you know the formula will be what? The formula is 1 plus I P into 1 plus I to the power n minus 1 by I. Right? And if you see this amount, this factor is given. This factor is given 2.91371. Therefore, we have to find out the principal amount. P into this gives you 70,000. The loan amount is 70,000. Okay? Therefore, this total value, 1 plus I to the power n minus 1, that means P into 1 plus I is how much? I is 14%. 0.14. N is equal to, is given is 4. N is 4 to the power 4 minus 1. Y is 0.14. This value which you see is given 2.91317. So, it is simple. P is the amount of loan repayment per year which we have to find out. This is what we have to find out in the problem, right? So P multiplied by 2.91371. So P into 2.91371 is equal to 70,000. So you can easily find out P. P will be 70,000 divided by 2.91371, and it comes to rupees 24,024. 24024.35. Okay, so this is how we apply the annuity concept, and this problem came in one of the earlier MTPs, model test paper, and in one of the earlier years. So this will be useful for you. The value is given, right? So the annuity factor is given, so it becomes easy for you to solve it just by dividing. In the last example, you have to multiply, right? But in this case, since you have to find out the yearly payment P, so just a case of division and you arrive at the value. Okay. Now we go to exercise 4B and we solve some problems and then we'll move on to the applications quickly. Okay. So we go to some problems. I request you to move to exercise 4B now. Exercise 4B. So the first problem, problem number one, if P is equal to 1000, R is 5%, R, that is interest, is 5% per annum, N is 4, what is the amount and compound interest? So we have to find out the amount and the compound interest. We don't know the compound interest, we don't know the amount. Options are given, so how do you find out? So here we know that compound interest amount A is equal to P into 1 plus I to the power N. Here P is 1000. So 1000. 1 plus I is 5%. That is 0.05. So 0.05. N is 4 to the power 4. So it is 1000 into 1.05 to the power 4. So you will be getting, if you calculate, you will be getting, the amount is coming to 1215.50. This is the amount. If this is the amount, so we have got the first answer. Amount we have got. So what is the compound interest? Right? Compound interest is how much? Compound interest is amount minus principal. Amount is this. So 1215.50 minus principal. Principal is 1000. Principal is 1000. So we arrive at the CI, compound interest, that is 215.50. So this is the answer, and this is part 1 and part 2. Right? This is number 1, exercise 4B. Okay. Now we go to exercise number 4B, page 4.20, question number 4. Okay. I'm rubbing this. This is an easy one to start with. We will take some numericals here and move on. So I request you to move to page 4.20 and we are doing example number 4. The question, please open the question. The question reads, a machine is depreciated at the rate of 20% on reducing balance. Now all of you know that there are two types of depreciation. You have the SLM, the straight line method, and you have the written down value method, also known as reducing balance method, right? And you have also studied that depreciation is covered under accounting standards issued by ICAI. Okay. Now the original cost of the machine is, original cost, C is 1 lakh. This is a problem which many of you requested me to do, and I am doing it, that's why, right? And I hope you'll be absolutely clear once the solution is done. Okay, now the scrap, original cost is given. The scrap value. What is scrap value? Scrap value means at the end of the useful life of the machine, what will be the recoverable value? Whatever scrap, right? In Hindi we use the term kachra, scrapped, right? So the machine, after the continuous use over the life of the asset, ultimately becomes scrap, kabadi, right? So it has to be sold. It has to be just disposed of. The scrap value is 30,000. The original cost is 1 lakh. And the depreciation is 20% on reducing balance. We have to find out the effective life of the machine. So what is the effective life? We don't know. We have to find out. Okay. Now please note that here in the last few examples we went for 1 plus I to the power n. We added because the interest is added. But here it's a question of minus. Why minus? Because in case of depreciation, the value goes on reducing. That's why it is called reducing balance method. Okay. So the problem is if you just put the facts into an equation. Okay. So here we have the scrap value we know. We know the original cost 1 lakh, right? We know the scrap value 30,000. Depreciation is 20%, right? We know depreciation is 20%. 20% means 0.2. Fine. Now, you start with 1 lakh, depreciate for first year, balance, again depreciate, you go on. We have to find out the life of the asset. After the life of the asset is over, the remaining value is scrap. This is very similar to the annuity concept. In the case of annuity, you go on paying every year and the balance increases, right? In case of depreciation, you start from here. This is the size. Depreciate first year, depreciate second year, depreciate third year, depreciate fourth year, fifth year, and ultimately it becomes this much. This is the scrap which you throw away. So in case of annuity, you go on, you start from here. Pay first year, second year, third year, fourth year, fifth year. It grows bigger. In case of depreciation, you start from here. Original cost is 1 lakh. Depreciate for 1 year. Some value goes out. Depreciate for second year, third year, fourth year, reduce. Ultimately becomes scrap. I hope you are able to see the connection between annuity and this formula which we are going to use. Concept is same. In case of annuity, you add because the interest is added, but in case of depreciation, you deduct, you subtract, right? So, in this case, if you put the equation, so we started with 1 lakh, fine? So, what we do, we normally do P into 1 plus I, but here we will, to the power n, but here we will do P into 1 minus D to the power n. Here, D is the depreciation rate. See if you are clear with this, please. If you understand this, then absolutely fabulous, splendid, and you will be able to solve any problems. I am more than confident you will be able to solve any problems which comes on this chapter, right? So, in case of annuity, in case of sinking fund, you start from here, initial corpus. Every year pay, and it becomes big. In case of depreciation, you start with the original cost of the asset, depreciate every year, reducing, you get scrap. So in the case of sinking fund and annuity, I am moving up. From small to big, moving up. So upward arrow or plus. In case of depreciation, I'm starting from here. Machine is this much. Writing off, depreciate. So going down. I'm going down. So I'm going down. That is minus. Clear? Right? Okay. Can we proceed? Okay. So here what we see is 1 lakh original cost and 1 minus. So we will use minus. Here depreciation rate is 0.2. So it is 1 minus 0.2 to the power n. This n we don't know. This n we have to find out. Okay? Like in the other numericals, n is conversion period. Here n is the effective life of the machine. But this is equal to how much? This is equal to the future value. We know every year cash flow, you are adding cash flow, it becomes future value. In case of depreciation, you start with the original cost, depreciate, and you get what? Scrap. So the future value is nothing but the scrap value. In case of depreciation, the future value is nothing other than scrap value. So if you put the scrap value here, 30,000, I write 30,000. So now I think we have got an equation. Please see. So we get from here 1 minus 0.2 to the power n is equal to 30,000 by 1 lakh. That is P by 10. That is 0.3. 1 minus 0.2 gives you 0.8. So 0.8 to the power n gives you 0.3. If you solve for n comes to approximately 5.4. So the effective life of the machine is 5.4 years. Right? So I hope this is clear. You saw that the depreciation method is just the opposite of the annuity method. In case of annuity, we go on adding. In case of depreciation, we subtract. One more problem from exercise 4B on this concept of deduction. Okay, let's do. This is now page number 4.20. The same page, problem number 6. Many of you requested me to do this problem. Looks difficult, but it is actually simple. Just stay with me. So we are doing number 6 now. Fine, number 6. The population of a town increases. Okay, this is again increment. Okay. The population of a town increases every year by 2%. So every year the population goes up by 2%. Okay. So this year 100, next year 2%, 102. After that 2% of 102. It goes on like this. The number of years, the question says the population of a town increases by 2% every year by 2% of the population at the beginning of the year. Fine. The number of years by which the total increase of the population will be by 40%. Okay, is what? Simple. So every year it increases by 2%. In how many years it will ultimately reach 40% of the population? Right. The total increase will become 40% of the population. So let us assume that the population is P. Right. Now the rate of increase is 2%. Okay, which is 0.02. 2% means 2 by 100. Okay, so 1 by 50, 0.02. And the current population is P. The question says, after how many years this P will increase and become 140% of P. From P is this much. Population increasing. It becomes here. Okay. So this becomes 140 times of this. So this is P dash. So P dash will be equal to 140% of P. This is, population is this, increases every year by 2%, going up. After how many years it will reach a level where it becomes 140 times, that means 140% of the original population. 140%. That means it will increase by 40%. Okay. So we know that 140% means what? Means 1.4 times. Right? 200% is 2 times. 140% is 1.4 times. Therefore, the equation is like this. If you see the problem, the equation is like this. 1.4p. Okay? The increased population. This is equal to the original population multiplied by 1 plus 0.02. 1 plus 0.02 to the power n. N will be the number of years after which the original population will become 140%. So, if you see this problem now, if you just simplify the problem, 1.4p is equal to p into 1.02 to the power n. P cancels out, so you get 1.02 to the power n is equal to 1.4. 1.02 to the power n is equal to 1.4. If you solve, now this is where you have to use calculator, and last day I was talking about the calculator tricks. Try to use calculator often. That's why I request you to perform the problems, perform the solutions, work out with me, so that you can use the calculator frequently and you get the speed and the accuracy as well. So 1.02 to the power n is 1.4. If you go on multiplying, it will take some time, but eventually you will get n is equal to 17. So after 17 years, ultimately the population will become 140% of the original population. Now we move on to question number 8. Same exercise 4b. We are solving most of the problems. We move on to exercise 4b, page number 4.20, and the question number is 8. Okay, question number 8. Please see the question. The useful life of a machine is estimated to be 10 years and the cost is 10,000. Okay, useful life is 10 years. So n is 10 years. The cost of the machine is 10,000. The cost is given 10,000. Very good. Depreciation rate is given. Rate of depreciation is 10%. So depreciation rate is 10%. That is 0.1. You have to find out what is the scrap value at the end of its life. What is the scrap value at the end of its life? So you have the original amount is given. Okay. The useful life of a machine is given. That is, the cost is given. Sorry, useful life is 10 years. Cost is given. And you have to find out what is going to be the scrap value of its, of the machine. Okay. So, if you work on it, you will see that the formula is very simple. We know the cost. We don't know the scrap value. So in the last example, what happened was the scrap value was given. Okay. We have to find out the number of years. In this problem, in the given problem number 8, in problem number 8, the cost is given, the useful life is given, scrap value is not given. So we have to find out the scrap value. Scrap value we don't know. This is the question. So what we do, the formula is simple. You can apply the formula now. We know that future value is equal to cash flow into 1 plus I to the power n. But I explained this is in case of interest, which goes up. It becomes bigger. In case of depreciation, you start here and depreciate, reduce, and you get the scrap value. So it is a minus, is moving down, minus. So the formula is what? Original cost is 10,000, fine, into 1 minus depreciation rate. It is 10%, 0.1. So I write 0.1 to the power 10, because n is 10. So the formula here is P into 1 minus I to the power n, where P is the cost, 10,000. So this will be equal to what? This will be equal to the scrap value, which we don't know. This is equal to the scrap. So on the left hand side, if you simplify out, what you get is 10,000 into 1 minus 0.1 is how much? 0.9. So 0.9 to the power 10. So 0.9 into 0.9, no shortcut, you have to go on multiply and equal. You will reach, the value will be 3486.78. Okay, so this is the solution. Simple formula, just reversing the sign from positive to negative. Why? Because in case of depreciation, we reducing balance method. So the working out is here. We had the cost. We had been given the duration. The life of the duration, the tenure of the life is given 10 years. Cost is given. Depreciation rate is given. Scrap value we have to compute just by putting the value here. P into 1 minus I to the power n, where I stand for the depreciation rate, which is 10% here. We are able to solve it. Okay. Now I am taking up number 9. Okay. Question number 9, exercise 4B. Okay. Question number 9. We'll take 2 more questions, then we'll go to the applications. Okay. So question number 9. Right. Exercise 4B number 9. Question number 9 says, the effective rate of interest corresponding to a nominal rate of 7% per annum. So what is the effective rate of interest for what? For a nominal rate of 7%. So I is 7%. Nominal rate of 7% per annum. Convertible quarterly. It is compounding quarterly. Right. So compounding quarterly. Simple. Interest rate is given. How much is that? 7%. What is the duration? 1 year. How many months in 1 year? 12 months. So I write 12 months. Okay. Compounding is done quarterly. Right. So quarterly compounding means we know there are how many quarters? So it is being done every 3 months. 4 quarters. So duration of 1 quarter is 3 months. Right. So divided by 3. So we get 4. So n is equal to 12 by 3, which is 4. That is, conversion period is 4 in this case. But we also need to adjust the interest here. 7% is per annum. But what will be the condition when you have to compute the quarterly interest? Annually 7%. So what will be the quarterly interest? Right? So the quarterly interest QI is equal to 7% by 4, because there are 4 quarters in a year. Now 7% means 0.07. Divide this by 4, you will be getting 0.0175. This is the value of I. Okay, and you know that the effective rate of interest, what is the formula for effective rate of interest? We know effective rate of interest is equal to 1 plus I to the power n minus 1. So in this case, 1 plus I is 0.0175. So 1 plus 0.0175 to the power n. N is 4. So to the power 4 minus 1. If you calculate and simplify this, you will be reaching a percentage of 7.19. 7.19%. Right? So this is as simple as it. And I hope this is now clear to you. We are solving each of the problems. And we will take the last one, 14. Question number 14 of this exercise. Question number 14 of this exercise. So we are taking number of problems and gradually building up confidence and accuracy as we move along. Question 14. The compound interest on 4,000 rupees for 6 months at 12% per annum payable quarterly is how much? So the compound interest, fine, break down the problem on 4,000. So principal is 4,000. For 6 months, time is 6 months. Interest I is 12% per annum. Okay? And compounding is done quarterly. So write down the facts. The question is in the form of a sentence, multiple sentences. Our work is to break down the problem into facts, jot down the facts, put them into the formula, apply the figures, computation, and the answer comes out, right? So in this case, we have the compound interest is unknown. We have to find it out. Principal 4,000 is given. Time is 6. Interest is 12% and compounded quarterly, right? So in this case, we can find out since the duration is 6. Okay, first of all, we have to adjust the interest. 12% means 0.12. But this is for the full year and the interest is done compounding quarterly. So this divided by 4 because there are 4 quarters in a year. Okay, so the interest comes to 0.03. Fine. N is the number of compounding conversion periods. What is N? The duration is 6 months. Compounding is done quarterly. That means compounding is done quarterly, which means compounding is done every 3 months. And the total duration of the investment is 6 months. Okay? So N is equal to 6 by 3, that is 2. Okay? So if you look at the formula now, let's look at the formula. We have to find out compound interest. So we know that the compound interest CI is equal to P into 1 plus I to the power N minus P. So here we have P is 4,000 into 1 plus I. I is 0.03. 0.03 to the power N. N is 2 minus 4,000. So we have got the expression. If you work it up, if you just put your mind and if you calculate, so it comes to 4,000, 1.03 square. 1.03 square minus 4,000. That is 4,000 taking common 1.03 square minus 1. You will arrive at the value of 243.6. So 243.6. This is the compound interest on rupees 4,000 for 6 months at 12% per annum and payable quarterly, right? So we have done many of the problems. Now we move on to, okay, I'll take another one. Exercise 4B, number 13. Lucky 13, right? Lucky 13. We'll take 14 we have done, let's take 13 also. This is regarding population, birth and death in a particular town. Okay. So we are doing number 13. Exercise 4B, page 4.21. Okay. The annual birth and death rates per 1,000 is given. So the birth rate B is 39.4 and the death rate is given 19.4. The number of years in which the population will be doubled. So if the population is P now, it will become 2P. Population will be doubled. In how many years? We don't know. That is what we have to find out. And you can see that the birth rate is given and the death rate is given. This is per 1,000. So for every 1,000 there are 39.4 births and the number of deaths per year is 19.4 per 1,000 of the population. So we have to find out in how many years the population will be doubled. Keeping in mind the given parameter of birth and death. Right. So just apply your mind. Birth minus death. Here number of birth is more than death. Okay. So the difference gives you the net increase. Right. So if I write B minus D, this comes to 39.4 minus 19.4, that is 20. Okay. So we can write that this is basically, it comes to 20 per 1,000. Okay. So if it is 20 per thousand, you see the value is given per thousand. Birth is per thousand, death is per thousand. What we have done is just a common sense, birth minus death. So we have got 20, but 20 is for 1000. So on a scale of 100, it will become 20 by 1000 into 100, which is 2%. 2% means it is actually 0.02. 2% means 0.02. So for the population to double, the formula will be what? If say the population is 1000, we take it as 1000. So it will become double, that is it will become 2000. So we can write 2000 is equal to 1000. 1000 is the initial population into 1 plus the growth rate is 0.02. 0.02 to the power n, where n is the number of years. N is the number of years. So we have the birth rate and the death rate we have netted off. We have got 20 out of 1000. 20 out of 1000 means 2 out of 100, which is 2%. So it is 0.02. We have got 0.02. Doubling of the population, 2000 is equal to 1000. The initial population, right, multiplied by 1 plus growth rate, I, like interest, growth rate, to the power n. So if you solve for this, we are getting basically 1.02. So 1.02 to the power n is equal to, you are getting 2. Because 2000 by 1000, that is 2. 1.02 to the power n is 2. Now you may have to use logarithms, but in most cases, the value will be given. Otherwise, this becomes difficult, because in this case, n will work out to 35. So if you calculate, it will be a long calculation. I think in this type of problem, sometimes, the value is given. So to help us in the calculation part, otherwise the calculation will become very, very tedious and cumbersome. So in this case, n is 35. The value is not important. The process is more important, right? So value is something, whatever input you give, output will come. But the process remains the same. The entire procedure of solving the problem is most important. Okay. Now we move on, dear friends, to the application. So I move on to 4.10. Unit 4.10, we have done number of numericals from the study material, from the exercises, and we are now going on to the applications, and we start straight away with leasing, and this is 4.10 of your study material, unit 4.10, page number 4.34. Now if you talk about leasing, I have already explained the difference of lease and rent, right? It is almost the same. In case of lease, of course, that the duration is longer. Lease period is explicitly mentioned in the agreement, and Accounting Standard 19 issued by ICAI and Ind AS 116 issued by ICAI deals with leasing. These are the two important things. And basically, leasing means you are taking an asset on rent. Okay, if I speak in a layman's language, because for technical people like us, we use the term lease, but for a layman, they use rent and lease interchangeably, even though there is a slight difference between rent and lease. So normally, equipments and assets are taken on lease, land is taken on lease, and property, typically for the purpose of staying, property is rented out, can be residential property or office property, commercial property. Okay, so the question in this case is to find out whether leasing is beneficial or whether buying an asset is beneficial. If I buy an asset, I have to pay upfront. The cost of the asset is 1 lakh rupees. I have to pay 1 lakh straight away. But if I obtain the asset through leasing, in case of lease, I'll pay lease rental every year over the life of the lease. So I have to find out the present value of the lease rental which I pay and compare the present value with the cost of the asset. In other words, we have to compare the present value of the lease rental with the purchase cost, the purchase price. Okay? If the present value of the lease rental is less than the purchase price, definitely you should go for leasing. Don't buy the asset. by making a straight away payment. You go for leasing the asset, it becomes cheaper. However, if the lease rental present value, say the lease rental comes to 1,35,000, and if you buy the asset, the purchase price comes to 1,25,000, you should go for purchasing. It is cheaper. Okay, so let's do a problem on this. I move on to page 4.34, example number 36. I think this is the actual crux. This is the actual, the issue which we are going to tackle now, and we are going to solve problems. So we move to example 36. Page 4.34. We are strictly following the study material and the curriculum set by the institute, and we move to 36, example 36. Now the company ABC Limited wants to lease out an asset costing 3,60,000 for a 5-year period. So the cost is 3,60,000 and N equal to 5-year period. The rental, that means if you take the asset on lease, you get a commercial right to use the asset. The lease rental is R, which is 1,05,000 per annum. And you have to pay it annually starting from the end of first year. The hint is end of first year. That means it's like an annuity payment. It's an annuity regular. So I'm writing annuity regular. Why? Because the hint is given that you are paying from the, and the first payment is at the end of the first year. So end means it is a regular, annuity regular. And if you pay it at the beginning of the period, it becomes an annuity immediate or annuity due. Okay. Now, the rate of interest is given. Please see the problem, 14% and compounded annually. So, I is 14% and compounded annually. So, is the agreement favorable to the company? In other words, should you go for leasing or should you buy? If you buy, you have to pay 3,60,000 straight away, across the table. 3,60,000, give me the asset. Payment and asset, right? So, risk and rewards will transfer immediately. If I don't want to, this is a capital expenditure. It's a huge money, 3,60,000 straight away. Rather than that, should I take it on lease, right? And have the same use, and I pay the lease rental, 1,05,000 per year. Okay? So, it's a case of annuity. Right, so let us see the problem. So we have to first see 1,05,000 I am paying for how many years? For N is here equal to 5 years and the interest rate is 14%. N is 5 and I is 14%, that is of course 0.14. So what is the present value of this annuity you have to find out? Right, present value. So we have to see this payment. That means first year I am making 1,05,000. Fine. So if I just draw it here, please pay your full attention now, because a most important thing of capital budgeting and present value discounting I'm explaining. Very, very important. Okay. So now at the end of 1 year, so end of year 1, 2, 3, 4, 5, I am making 1,05,000 payment every year. 1,05,000, 1,05,000, 1,05,000, and the 5th year also 1,05,000. Fine. But the present value, 1,05,000 which I am paying at the end of 1 year. What is the present value of that? We know present value is equal to future value by 1 plus I to the power n. 1 plus I to the power n. Okay. So when n is 1, first year means n is 1. So the present value is 105,000 divided by 1 plus I, and I is 0.14. Okay? First year is over. So we complete the line. For second year, n will be 2. I remains the same, 0.14. So the present value becomes 1,05,000, 105,000 divided by 1 plus 0.14 square. Second year is done. Third year in this way will become 105,000 divided by 1 plus 0.14 cube to the power 3, because n is 3. This is the third year. Third year is done. In this way, for fourth year, it will be 1 plus 0.14 to the power 4. And for fifth year, it will become 1,05,000 divided by 1,05,000. For fourth year, divided by 1 plus 0.14 to the power 4. For fifth year, it will be 1,05,000 divided by 1 plus 0.14 to the power 5. Okay, so in this way, we are doing the present value. So now the idea is to find out the sum of this. Okay, present value of first year, PV1 plus PV2 plus PV3 plus PV4 plus PV5. We have to find out that value. Right? So I broke it down so that you know the steps. Once you know this chart, year end, lease rental and the present value. Once you know this, rest is easy. Okay. So the formula will be 1,05,000 is the payment you are doing every year. You know this is like an annuity regular. So we know for annuity regular, the formula is P into 1 plus I to the power n minus 1 by I. So here, if you calculate this particular part, right, if you find out at 14%, it will come to 3.43308. So this full part will become 3.43308. So 3.43308. So this 1,05,000 into this gives you what? Gives you the present value of the lease payments. Present value of the lease payments. And this is coming. Let's see. So this is coming to 3,60,000. 3,60,473.40. Okay. So if you multiply this. Now the question is, the company had an asset, and in this case the company is the lessor, right? They are the lessor. They want to lease the asset or they want to sell it, right? So whether the agreement is favorable. So definitely you can see the initial cost of the asset is 3,60,000, right? 3,60,000, and if they lease it out, what they are going to get, in this case, since they are the lessor, they will be receiving the lease rental. The present value of the lease rental is this much. So present value of the lease payments which they are receiving is this much. The cost is 3,60,000. That means if they sell it, right, they will get 3,60,000. But if they lease it out, the present value works out to 3,60,473. So this 473.40 is extra. Therefore, leasing is favorable. And as the company, as the lessor, can go ahead with the leasing because there is a marginal utility, right? I'm using a term from economics. Marginal utility, you get some more utility in the form of leasing. You get some more money from leasing if you lease it out. Of course, we have considered the time value of money. We are not adding up this part. Okay, we're not doing it because we are considering the time value of money. We have looked at the present value column and we have found out the present value factor, which is 3.43308. Okay, so this is the example. Now we move on to example number 37 on leasing. Okay, and then we will go into capital expenditure and compounded annual growth rate and perpetuity, and that will be the end of today's session, and it will complete the entire chapter in a totally in-depth manner. Okay, so example 37. So let's go to example 37 now. And a company is considering a proposal of purchasing a machine either by making a full payment of rupees 4,000. So now here the company becomes the purchaser. They either want to buy the machine at 4,000 rupees or they want to lease it for 4 years by paying an annual lease rental of 1,250. So either they buy it or they pay a lease rental of 1250 rupees per year for 4 years. Fine. The interest rate is given 14%. So I is equal to 14%. You know that I 14%, interest 14% means it is 0.14. So the question is, which course of action is preferable? And the compounding is done annual. So I am writing annual compounding, 14% interest. The cost of the asset is 4,000, and if you want to lease it, it becomes lease rental is 1250. So just by applying the given formula, right, we apply here P is 1250. So 1250 per year if you pay. So it is like what? It is like an annuity, right? You are paying. So first we want to see what is the present value of the lease rental which you are paying. So if you look at the present value of the lease rental, it comes to, please note that the price is 4,000 and first year you are paying 1250, second year you are paying 1250, third year 1250, fourth year 1250. Okay, this is the lease rental which you are paying. Year 1, 2, 3, 4. Fine. But now that we know time value of money, we have to go for the discounting or we have to go for the adjustment. What is the adjustment? First year, what you pay 1250, fine. So the present value is 1250 by 1 plus I. I is 0.14. So 0.14. First year is done. Second year, 1250 by 1 plus 0.14 square. Third year, 1250 1 plus 0.14 to the power 3. Done. Fourth year, 1250 by 1 plus 0.14 to the power 4. Okay. So this is the present value. This is the present value for year 1. Present value for year 2, PV2. Present value for year 3, PV3. And present value for year 4, PV4. This total, this will give you PV 1 plus 2 plus 3 plus 4. Right? Now, this is the concept. This is the understanding. This is the analysis. Now, we are solving it. So, 1250 per year, if you take common from here, the present value factor comes to, if you calculate the present value factor comes to 2.91371. So this is the rental per year and this is the present value factor. This comes to 3642.11. That means the present value of the lease rental is 3642.11. Right? If you buy the asset, you have to pay 4,000. If you lease the asset, the present value comes to 3642.11. So it is less than 4,000. Therefore, leasing is preferable because the present value of the lease rental is less than the purchase cost. The purchase cost is 4,000. The lease rental is 3,642.11. I hope the logic is clear. You can now consider, you have understood decision making, leasing or buying. Right? Fine. Now we go to capital expenditure and 4 point. So we rub this out. I hope this is clear. We move on. 4.10.2. Okay. So we proceed to 4.10.2. 4.10.2, this is CAPEX. So CAPEX, capital expenditure, and it is an investment decision. You also know that what we do in capital expenditure is we find out the same thing, the present value of the cash flow. I buy a machine, I put it to use, every year I earn some returns in the form of cash flow. Just like we did. Present value of year 1, present value of year 2, present value of year 3, year 4. We added it up. Same thing we'll do here. to find out the present value of the cash inflow. That means that the cash which is coming in. That means by using the asset, I am earning. Asset is a resource which gives cash flows. You know the definition of asset, right? So we will find out whether by using an asset, by investing in an asset, I am getting money whose present value is more than the cost of the asset. I pay 1 lakh rupees to buy an asset. Okay, I pay 1 lakh rupees to buy an asset. I use it for 4 years. Okay, the present value for 1, 2, 3, 4. Present value in year 1 I get is say 15,000. Or say, let's make it 20,000. Chalo, round figure, 20,000. Second year I get say present value comes to say 15,000. Third year the present value comes to 13,000. Fourth year the present value comes to 10,000. If I purchase it at 1 lakh rupees and if this is the present value I am getting, first year this, second year this, third year this, fourth year this, let's add up. 20 plus 15, 35,000 plus 13, 48,000 plus 10, 58. So this is the present value of the cash flow. This is 58,000. Have I taken a right decision? What do you think? I spent 1 lakh for a machine, but the present value of the benefit I am getting is only 58,000. So decision is wrong. Okay, this is capital expenditure. But if this amount was 1 lakh, say 10,000, then the decision is right, because by paying 1 lakh, I am getting 1 lakh 10,000. Okay, so the present value of cash inflow is more than the cash outflow. So I get a surplus, I make a profit, I get some return, I get some benefits. Okay, hope it's clear. Right, so now we proceed to some numericals. Best way to learn is numericals. Fine, so let's take number 38. Okay, so example 38, example number 38, and it is there in the study material, example 38 from the study material. So a machine can be purchased for 50,000. So a machine can be purchased for 50,000. Purchase cost, see. The machine will contribute benefit of rupees 12,000 per year. So the benefit is 12,000 per year. Fine. For how many years? For the next 5 years. So n equal to 5. 5 years. The borrowing cost is 10%. Now what is borrowing cost? Big question. Borrowing cost. Borrowing cost is 10%. Fine. Any idea? Borrowing cost. If I borrow funds, I have to pay a cost. Right? I incur a cost. Right? There is a accounting standard, you know, A16, accounting standard 16, issued by ICAI, our institute, and it is on borrowing cost. Borrowing cost is basically the cost of funds. If I borrow money, right? I have two types of borrowing. I have two types of funds, equity share and debt. So one is equity and the other is debt. When I have shares, I pay dividend. So dividend is my cost, right? Sometimes it is shown by KE, the cost of equity share capital. And when I get loans, debt, right, I pay interest. For equity shareholders, I pay dividend, KE, and for debt, I pay interest. That is KB, cost of debt, cost of equity. Okay, cost of equity, cost of debt. This is known as the weighted average cost of capital. Say now you have 60% equity, 40% debt. So we have to calculate the weighted average cost of capital. Weighted average. So it will be how much? If 60% equity and 40% debt, it will be 0.6, 60%. Into the cost of equity, KE, plus 0.4 into KD. This is called borrowing cost. Okay, this is called borrowing cost. Right? That's why it broke down into formula, and this is called weighted average cost of capital. Capital can come from two sources: equity capital, debt capital. So you have cost of equity and cost of debt. Cost of equity means the dividend you are going to pay to your equity shareholders, and cost of debt means the interest which you will be paying to your lender. It can be a bank, it can be a financial institution. Right? Fine. So this is what is called cost of debt, cost of equity, and this is borrowing cost. Fine. So your borrowing cost, now I'm rubbing this part, the borrowing cost is 10%. Always remember, when we are using this percentage, interest in this case is borrowing cost, and it is 10%, which means it is 0.1. Okay, so a machine is purchased, can be purchased for 50,000. If I lease it, rather if I use the machine, I will get a benefit of 12,000 rupees per year. Okay, so once again the table, year 1, 2, 3, 4, 5. This is the benefit and the present value. Okay, first year benefit is 12,000. Second year benefit 12,000. Third year 12,000. Fourth year 12,000. Fifth year 12,000. Very good. Okay, but we have to adjust it for the time value. That is why we are learning this chapter, time value of money. Why? Because 12,000 which you are going to spend in the fourth year, it is not worth 12,000 today. So you have to find out today's equivalent of 12,000 which you are spending after fourth year or third year. Okay, so first year the benefit you will get is 12,000. The present value is 12,000 divided by 1 plus I. I is 0.1, 10%. So 1 plus 0.1. First year is over. For second year, the present value is 12,000 divided by 1 plus 0.1 square. Third year, it is 12,000 divided by 1 plus 0.1 to the power 3. Fourth year, 12,000, 1 plus 0.1 to the power 4. And the fifth year, last year, 12,000 into 1 plus 0.1 to the power 5. So, we are trying to add up this full. So, PV1 plus PV2 plus PV3, PV means present value, plus PV4 plus PV5. So, this shows the benefit per year. This column shows the present value figure. Now, the formula should be very clear to you. And this is the PV1 plus 2 plus 3 plus 4 plus 5. Now, using this particular present value factor, right? The present value factor is given, so it is 3.79079. So, if you multiply this 12,000, which is this 12,000 here, multiplied by the present value factor, PVF, you will be getting 12,000 into 3.79079, which comes to 45,489.48. Okay, this is the benefit which you are getting, right? Please note, the present value of the benefits is 45,489. So this is the benefit. I wrote here benefit and the present value of the benefit. So this amount is what I am going to gain, and this is what I have to pay. So today if somebody tells you that you pay me 50,000 and I am giving you a benefit of 45,489, will you pay? No. Because your benefit which you are getting is less than your cost. You have to pay 50,000 today to buy the machine. If you buy the machine, then only you will get the benefit. And the benefit present value is 45,489. So the machine should not be purchased. If you purchase the machine, you are incurring a net loss. Normally we use the term net present value, but here the net present value is negative. Net present value is equal to present value of the cash flow minus the cost. Here the present value, PVCF, the present value is coming to 45,489.48 minus 50,000 minus C. So this is negative. Net present value is becoming negative. Therefore, the machine should not be purchased. That is the final decision which the company has to take. Okay. Now I come to bond valuation 4.10.3, 4.10.3. I hope this is clear. We saw the machine, the cost of the machine, the benefit per year. We saw the borrowing cost. I explained about the borrowing cost of debt, cost of equity, weighted average cost of capital, and then we moved on to solve the problem. We had 4 columns, year 1, year 2, this is the first column, second is the benefit, third is the present value, and fourth is the PV1, PV2. Putting it together, we saw the present value of the benefits coming to 45,489, whereas the cost is 50,000. So, we are arriving at a negative net present value. NPV, net present value, is the present value of the cash flow minus the cost. So you are getting a benefit of 45,489, but you are giving up 50,000. It is not acceptable. It is not logical. You are not getting any benefit. Your NPV is negative. So machine should not be purchased. Right. So I remove this now and we move on to the next section on bond valuation. Okay. So we move on to bond valuation now, and this is 4.10.3. Concept is same. The terms are different. You know, a bond is nothing but a security in which the issuer, say a company issues the bond, fine, I buy the bond. And if I buy the bond, I will be entitled to interest payments over the life of the bond, and the interest will be fixed. So this is also like an annuity payment. I'll be receiving interest payments over a period of time. Periodic cash receipt will come to me, but I'm paying for the bond now. So it's a cash outflow immediately. I'll be getting interest every year. Okay? And at the end of 3 years, 5 years, 7 years, whatever be the life of the bond, right, I must see whether the present value of the interest which I have received is more than the price of the bond. In other words, if you pay rupees, let's say you have a bond has a face value of 1,000 rupees. You know it is called face value, right? Face value or par value of 1,000 rupees. You have purchased it at 1,000 rupees, fine. And you are getting interest. Okay. So you are getting, say the bond has a life of 4 years. So year 1, 2, 3, 4. In the first year, say the bond is giving you interest of say 7%. 7% interest. Okay, let's take the higher side. 7%. These days not possible. You know the repo rate has come down, but let's be optimistic. Let's think of a rosy picture. 7%. 7% bond, and so you are getting an interest of 70 rupees in first year, 70 in second year, third year 70, fourth year 70, and in the fourth year you will also get back this 1,000 rupees. So you will also get back 1,000 plus 1,000, because whatever money you have paid, they will give it back to you. Redemption. In shares, we call it redemption of shares. Okay, so they are paying this 70 every year. Why? Because they are using your money of 1,000 rupees. They are using money for 1,000 rupees. I mean, you have paid 1,000 rupees, you have kept 1,000 rupees with them. Every year they are using it, they are earning some return. From the return, they are paying you 70%. And at the end of 4 years, they are giving back that 1,000 rupees to you. That is called redeeming, repaying back, redemption. So it is called, this 1,000 is called redemption. You will learn this in your accounts, in share capital, redemption of debentures, redemption of shares, etc. Right? In share capital. So this is how a bond operates. Okay. So bonds are issued for a fixed term, maybe 5 years, 6 years, 7 years. Interest rate is fixed. This is how a bond operates. So if you pay 1,000 rupees and if you find that the present value, so this is the present value. Say the present value in year 1, 70 rupees comes to 60. This 70 comes to 50. This 70 comes to 45. This 70 comes to 40. And this 1,000 at the end of 4 years comes to say 700. So let's add up now. 60, 50 is 110. 110 plus 45 is 155. Plus 40 is 195. 195 plus 700 is 895. You tell me. I get a benefit of 895. Present value of the benefits is 895. Okay? The interest is 7% on the face value of the bond, right? The 70 rupees interest in the first year, 70, 70, 70 and 1,000 back in the fourth year. But when you are computing the present value, say this is the value. 60 for first year, 50 for second year, 45 for third year, 40 for fourth year and 700 is the equivalent of 1,000. So if 895 is your total returns on a present value basis and you have paid 1,000, is it a good investment? No, it is not a good investment. That means you have paid more. The purchase price is more. In other words, the bond is overpriced. Are you getting the idea now? This is valuation of bond. Very, very interesting topic. Later on, even after becoming chartered accountant, you can go for post-qualification course in valuation if you want to become a valuer, right? So you will learn all these things once again. So that's why I said this chapter is the foundation, builds up your foundation as a chartered accountant. Okay, so this is the bond is overpriced in this case. So let's look at example 40. We'll just do one example. I hope this is clear, rubbing this part. So we are doing example number 40. Please see that the applications of this chapter are all in the area of a chartered accountant's work. Leasing versus buying. Okay, bond valuation. These are all CS job. Okay, so now we look at example 40. An investor intends purchasing a 3-year 1,000 par value bond. 1,000 rupees is the value, par value. N is 3-year bond. Interest rate is 10%, I is 10%. That is 0.1. At what price the bond may be purchased if it matures at par and the investor requires a rate of 14%. Okay, so interest he is getting is 10%. That means 10% of 1,000. That is 100 rupees. He will get 100 rupees every year. But the person wants a return of 14%. So in this case, the discounting factor is 14%, that is 0.14. Please note this. This is the interest you will get, 10% of 1,000. Okay. So the price is 1,000 and at maturity, he will be getting back 1,000 rupees also. Okay. So whether this pricing is correct or not. So if you look at the present value, once again, so the life is 3 years, right? So year 1, 2 and 3. Fine. First column. He is getting 10% of 1,000 rupees is the interest rate. So he is getting 100 rupees. So interest column, 100 rupees in the first year, 100 rupees in the second year, 100 rupees in the third year plus he will get back this 1000. It is clearly mentioned in the problem that he will be at maturity, he will be getting back the face value of the bond. It is written in the problem that at what price the bond may be purchased. Now, if it matures at par, maturing at par means he will receive 1000 rupees only. If it is written that it matures at a premium, that means he will get back more than 1000. If it is written that he will, at maturity, the bond will be repaid at a discount, that means in the third year, he will not get 1000, he will get something less than 1000 at a discount. But here it is given, you will receive it at par, right? Therefore, if you look at the present value factor, what is the present value of 100 rupees today? It is 100 divided by 1 plus I, and I here is 14%. This I is the interest. This I is the discounting factor, 14%. So 0.14. First year is done. Second year he will get 100 rupees. The present value is 100 divided by 1 plus 0.14 square. Done. Third year he is actually getting 100 plus 1000. So in all he is getting 1100, 1000 plus 100, 1100 divided by 1 plus 0.14 cube. N is 3. Here N is 2. Here N is 1. So if you add this column, PV1 plus PV2 plus PV3. If you add these three, it is coming to 907.125. That means the purchase price of the bond should be 907 rupees 125. The face value is 1000. Face value can be anything, but you should purchase it at 907 so that whatever you pay will be balanced by the interest and by the repayment you will be getting. Okay, if you buy this bond at 1000 rupees, sorry, it is a case of overpricing. That means you are paying more. I was mentioning about overpricing. So the maximum price at which you should buy this bond is 907 rupees. I hope this makes sense. Once again, I am repeating. It's already 4:25. We have some more things to do. Year 1, 2 and 3. You have the interest and the redemption of the bond is done at the end of the year 3. You have the present value calculation. From this you get 907, which means that the maximum present value which you are getting is 907, which means this is also the maximum price which you should pay. If you pay more than this, that means what? Say if the company tells me that, well, you have to pay 950 rupees. If they ask me to pay 950 rupees, should I buy? No. Because if I pay 950, the benefit I am getting is 907. But if they tell me that yes, you can buy the bond at 900 rupees, then it makes sense. Because I pay 900, I get 907.125, little bit extra. There is some benefit. Okay. So the net present value in this case will become positive. If I buy it at 900, but here the maximum price is 907. Okay. Now the last one is we go to perpetuity and we look at what is perpetuity. Perpetuity is nothing but simple way put forward. If I put it in a simple way, it's an annuity which goes on forever. So perpetuity is an annuity in which the payments will go on for indefinite time, indefinite long time. And in case of perpetuity, it means that if I keep money in a company and the lock-in period, there's no lock-in period. Okay. So perpetuity means no lock-in period. No lock-in period. That means forever, indefinite period, 30, 40, 100 years, go on. Okay, generation will come and go, but the money is blocked. But every year you get some return. So in case of perpetuity, please note, it is indefinite and no principal repayment will take place. No principal repayment. Like shares, once you buy the shares, the company gets the share capital. The share will change hand, but the share is held by the company. The share application money, the share allotment money, the entire share capital, paid up equity capital is held by the company. Unless the company goes for a share buyback. Okay. So in this case, the formula, please remember one small formula. The price of perpetuity is basically the coupon rate. So in this case, it will be R by I, where R is the payment or the receipt which you are getting, and I is the interest rate, right? Interest rate per payment of receipt, right? Please note here, the principal will never be repaid. It is a indefinite life. And if I go to one more case, and that is a case where the interest increases over a period of time. That means I have a perpetual investment. You know, the word perpetuity comes from the word perpetual. Perpetual means lifelong, indefinite period, no definite life. Right? It's like infinite period. Okay. So in case of perpetuity, what happens sometimes, say I am getting, my money is blocked in a company and the company is paying me every year 6%. So in this case, I is 6%. Now, there may be a growth every year. First year I get 6%. Next year I might get a little bit more. Maybe the growth rate G is say 2%. It might so happen. So every year, first year 6%. Second year 2% more. Then 2% more. Then 2% more. So the growth curve will be like this. Like a staircase. And it goes on. It goes on forever. But the growth increases over a period of time. This is called growing perpetuity. Growing perpetuity. Growing. It's growing. From small to big, big. Growing. Okay. So it's a growing perpetuity. Just note the formula for that. A very simple formula. Not at all a complex one. Right. The present value of growing perpetuity. A growing perpetuity is what? It is equal to R divided by I minus G, where R is the payment which you get every year, right? So R is the payment. I is what? The interest rate. And G is what? G is what? G is the growth rate in the interest. So maybe the interest is 6%. Okay. But every year there is a growth of 2%. So this 2% growth, G is the growth rate. Growth rate of what? Growth rate of the interest. So let's do a small example, and always remember that I, very important, I should always be greater than G. Because this formula, I'm not going into the formula, it's the derivation of the formula is beyond the scope of our discussion, not included for our syllabus. But if you really want to know, it's an infinite geometric series, and there I should be more than G. If I is less than G, then the denominator will become negative, and it will basically become, in theory, it will become infinite. Okay, so a growing perpetuity where the growth rate G, if G is more than I, then this type of sums you will not get, because it shows a case where the growth is more than the interest rate. It will have an infinite value, because ultimately the formula we are using, this R divided by I minus G, this is actually based on infinite geometric series. Okay, we will do next, I think, possibly tomorrow we have permutation, then combinations, then we will do GP, AP and GP, arithmetic progression and geometric progression. So there I will discuss more about geometric series. So let's look at example 42. Simple example on perpetuity. using the growth model. Very simple question. Example number 42. Assuming that the discount rate is 7% per annum. The discount rate is 7% per annum. Very good. How much should you pay to receive rupees 50 growing at 5% forever? Every year you will receive 50 and it will grow at the rate of 5%. So G is 5% forever. So how much should you pay? So every year I am getting 50 rupees. So R is 50. Fine. So how much should I pay to invest in a scheme where every year I will get 50 rupees? It will go on forever and the interest rate is 7%, right? And the growth is 5% every year. So the formula in this case, R is 50, I is 7%, that is 0.07. G is 5%, that is 0.05. And we know the present value formula for a growing perpetuity I showed you is R divided by I minus G, that is 50 divided by 0.07 minus 0.05. So it comes to 50 by 0.02. Right? So it comes to 2,500. Okay, 2,500. That means if I want to invest in a scheme which gives me 7% interest and every year 50 rupees go and forever and growing at the rate of 5% every year, then the maximum I should pay is 2,500 for such a perpetuity. So you see, ultimately these are nothing but, these are nothing but questions on annuity, sinking fund, annuity regular, annuity due, annuity, when we talk of annuity regular, annuity due or annuity immediate, the concept is same. Amount is paid or received every year for a definite period of time. There is an interest rate I, there is a number of years N, and the same formula, applications are different. Right? Now coming to net present value, I've already showed you net present value, how to compute net present value. We were looking at that bond example. We looked at the machine example where we saw the benefits. So that means if the cost of a machine is say 10,000 and the present value of the benefits is 12,500. Cost is this. I wrote the formula, you must have noted it. Net present value is equal to the present value of the benefits minus cost. So in this case, 12,500 minus 10,000. So it is a positive 2,500. So NPV, if NPV is positive, that is if it is greater than or equal to 0, then you can accept a business proposal. If NPV is less than 0, then reject. That means if a company has an option of buying a machine at 10,000 rupees, but the present value of the benefits is 9,600. Should you buy? No, because in this case, the present value of the benefits is 9,600. So the NPV is equal to 9,600 minus 10,000. That is minus 400. That means it is less than 0. So you reject. That is NPV. Okay. Let us go into example 43, page 4.38, example number 43 on NPV, right? So we have done leasing, we have done bond valuation, we have done present value and net present value. We have also done perpetuity, all the applications possible, plus in details I have also done number of problems with respect to the effective rate of interest and also with respect to the annuities. Okay, so this is page 43 and example 43 and page 4.38. Page 4.38 and the example is 43. The question is, compute the net present value for a project with a net investment of 1 lakh and net cash flows. Year 1 is 55,000, year 2 is 80, and for the third year is 15,000. So the same table, if you see, which I was doing here, the same thing is given here. So the first table, if you see, is here. You have 3 years, so 0, 1, 2 and 3. You have the net cash flow, CF. First year, you are investing in the project. So what is the amount? 1 lakh. So 1 lakh is negative because it's a cash outflow. So I denote it with a bracket, 1 lakh. First year, how much am I getting? 55,000 is positive. Second year, I am getting 80,000 and the third year is 15,000. So 80,000 in the second year and third year is 15,000. Very good. Now we have the present value. If you see the PVIF, that is the present value figure is given. Right. So if you look at the figure is given at 10% of course, because it is mentioned that the cost of capital, that is I is 10%, it is 0.1. So the present value figure is given, which helps to calculate, and your workload comes down drastically. The present value factor for first year, that is n equal to 0 is 1, of course. For n equal to 0, for n equal to 1 it comes to 0.909. For second year it comes to 0.826 and for third year it comes to 0.751. Now what is this 909 figure? Actually it's what? 1 by 1 plus 0.1. This figure is actually 1 by 1 plus 0.1 square. And this figure is 1 by 1 plus 0.1 cube. Okay, so you don't have to calculate so much. That's why the calculation is done, right? Is given. So now you have to find out the net present value and whether you should actually accept this. So here we write the net present value. So this cash flow into this column, PVF, will give you the net present value here. In fact, the total, you'll get the net present value once you summarize. So 1 lakh into 1, it is 1 lakh minus. Fine. You have 55,000 here into 0.909, which gives you 49,995. This is the first cash outflow which takes place in the first year. Second year you have 80,000 into 0.826. This gives you 66,080. And the third year you have 15,000 into 0.751. This gives you 11,625. So if you net off, if you add these three and deduct 1 lakh, you are getting 27,340. That means we have a NPV of 27,340, and therefore the net present value is positive. So here NPV is positive. That means it is greater than 0. And that is the reason why the company should accept this project. So we had the year, we had the cash outflow, 0 year, cash inflow, first year, second year, third year. We had the present value factors, we multiplied them, we got the net present value table, and we got the net present value after adjusting 1 lakh. So this plus this minus 1 lakh gives you 27,340, which is the net present value. Since it is positive, it is more than 0, we accept the business proposal. Okay. Lastly, we have a very brief discussion of, I'm rubbing this. I hope this is clear to you. And we have gone into fairly detailed discussion and analyzed each and every point which is given in the study material. Okay. We now go to 4.13. So unit 4.13, we are absolutely towards the end of the session. 4.13. It's almost 4:40 now, and last few discussions. 4.13, page number 4.39. So this is something I have already discussed, and that is regarding the rate of return, nominal rate of return. Last day and today also I was discussing about inflation, and I also stated that if the inflation rate say is 6%, and say for example the nominal rate of return, I am getting a nominal, right? Implicit rate, say the nominal rate of return is 8%. That means I am getting 8%, but 6% is the inflation. So what is the net amount? This part. It is 8 minus 6, that is 2. So my real rate of return is 2%. So the formula is real rate of return is equal to what? Real rate is equal to the nominal rate minus inflation. So please remember this. I think we discussed a lot about inflation, right? And what is the impact of inflation on purchasing power? Of course, the opposite of inflation is deflation. Inflation is a gradual increase of prices which leads to a reduction of purchasing power. Deflation is a gradual softening of prices, reduction of prices which leads to increasing purchasing power. So please remember that the real rate of return is equal to nominal rate minus inflation. So if my nominal rate is 8% and my inflation rate is 6%, my actual real rate is 8 minus 6, that is 2%. Last is the compounded annual growth rate, and I'll use it, I'll just take an example to show it. Compounded annual growth rate we always use to show the performance of a company. Say what is the annual growth rate in terms of revenue. Okay, so when we talk of CAGR, we talk about 2-3 things, and that is we talk about its growth. It can be the revenue. So when we talk of CAGR, we talk about the revenue growth. We may talk about the profits. We may talk about the customers, how many customers are getting in, how many registered customers are coming in. And we can also talk about other parameters of a company, growth parameters. For example, how many subscribers, right, you have increased, how many hits, how many likes, what is the growth in the number of likes of a new, say, a new movie, for example, right? So this is compounded annual growth rate. The formula is very simple. We'll take an example. You will understand the formula. So we are taking page 4.39, the example given in page 4.39. Okay, the example given in 4.39. And so normally, let me tell you the also the applications, before moving on to the example. The applications of CAGR. First of all, CAGR concept is used when you want to find out the return on a mutual fund. So any investment fund. So return. Number one is return. Okay. Sometimes we talk about NAV, net asset value, in case of a mutual fund. So what is the growth in the NAV of a mutual fund? Yes, we use this formula. When we want to find out the growth in profitability, when we want to show the growth in revenue, when we want to show the, when we want to compute the growth in, say, population, for example, population, when we want to show the growth of subscribers. Okay, so when we want to find out what is the performance of a bond, okay, we saw the bond valuation, bond performance. So for all these, performance related figures, it is usually CAGR, compounded annual growth rate, which is used. Okay, so these are the applications. Now let us see the numerical. The numerical says that the revenue of a company is given for 2013. Here is here and the revenue is here. So we have 2013, 2014, 2015 and 2016. Okay, 2013, 14, 15 and 16, and the revenues are given 100, 120, 160 and 210. You have to find out the CAGR. Okay. So time T0 is 2013 and Tn, that is n is equal to, of course, here 1, 2, 3, 4, n is 4. So here Tn is 2016. So 3, 1, 2, 3. So the difference is 3. Okay. So 6 minus 13, 16 minus 13. Now, since it is 3, so here n is equal to 3 here. And now if you see the CAGR revenue, if you see the difference of the revenue, so highest one, that is revenue in the nth year, is 210 and the revenue in the 0 year is we have 100. So the formula of CAGR is the value in the nth year by the value in the base year, 0 year, to the power 1 by n minus 1. Okay, simple formula. You have dealt with more complicated formulas before. It's a very simple formula. Vn by V0 to the power 1 by n minus 1. So in this case, Vn is 210. So I write 210. V0 is 100. So by 100 to the power n is 3, 1 by 3 minus 1. So it comes to 1.2774 minus 1, that is 0.2774, and 0.2774 means 27.74%. So this is the CAGR in this example, and the formula, please remember, is Vn by V0 to the power 1 by n minus 1. Okay. So with this, we move on to the last few minutes, and that is on the queries. I think received number of queries and questions. Today's queries, I'll take it up sometimes in the next session. I think we have completed all the areas. We looked at time value of money, why time value of money. I explained about inflation. I explained about the interest payments, risk, premium in case of interest. We looked into two types of interest, simple interest and compound interest. We did number of numericals on compound interest, and then we also looked at the effective rate of interest. There again a formula, and we did number of problems on that. We proceeded thereafter to discuss in detail about annuity payments, annuity regular, annuity due, or annuity immediate. We again saw two formulas and did number of problems from the study material as well as from the exams. Then we proceeded forward and looked at, after the annuity, we looked at sinking fund. Then we analyzed and discussed in details about present value, future value, and eventually we moved into something called the applications. In the applications, we have looked at leasing versus buying. Then we looked at the net present value. We have discussed in detail about also bond valuation. Then we looked at perpetuity, perpetual payments. Then we also factored in the growth factor in perpetuity, right? We considered the growth factor I minus G. Plus, we have also discussed about the formula, shortcuts to be used, especially in case of the difference of compound interest and simple interest, compound interest and simple interest in case of the duration. When the duration is up to 2 years, then we looked at 3 years, we looked at 4 years, and finally we have completed with the discussion on the net present value. We have looked at the present value of cash flows, when to accept a business proposal, when NPV is positive, when it is more than 0, NPV less than 0 means you reject the proposal, and we have looked at finally the compounded annual growth rate. These are the applications. So return calculation, NAV calculation, profitability, revenue, population growth, subscriber base, customer base, bonds performance, and now we have seen the formula Vn by V0 to the power 1 by n minus 1. So the entire chapter we have done in details. Now coming to some of the queries. K. Durga Jyoti has said that she's from Chennai. She has said that for November exams, when do we have to pay the fees online, or whether it will be, how many days the exam will be conducted. So I request you to please see ICAI.org. Tejasri Badak from Aurangabad, she said, in a case, if you have a cube of 20, what is the shortcut? No shortcut. Cube of 20 means 20 into 20 into 20. Cube of 20 means 20 to the power 3. So just multiply. Mayank Prajapari and Roshni Bedwal, I think I have explained example 21 once again today. Also, I have done question number 4, 6 and 8 of page number 4.20. I took Vaibhav Upadhyaya's question regarding lease versus rent. Gunjan Dikshit has asked the question. She is from Bharatpur. What will be the mode of exam, online or offline? Please see ICAI.org for the latest guidelines. Rohit Agarwal, Kuldeep and Dheeraj from Jaipur, Jammu and Belgaum respectively. How to find CAGR? Yes, we have done CAGR. I hope you have got your answer. Shubham Kumar from Bhagalpur. What is valuation of bond? Already done. You must have followed the class. Navya from Delhi has asked, if per annum is not given with the interest rate, then conversion period will not be applicable. Well, the interest rate and the per annum will be mentioned so that you can find the conversion period end. Shreya from Tamil Nadu has asked, sir, do questions come from outside the study material? Yes. Ritvik Mohite from Maharashtra. Sir, perpetuity means what? You have seen perpetual payments. We saw the formula R by I, and we also saw growth in case of perpetuity. I also explained that the growth G must be less than I. If G is more than I, then it becomes theoretically infinite. And those type of problems will not come, infinite type of problems. Ashutosh Pradhan from Odisha. Sir, which type of interest is calculated in case of mutual fund? Thank you, Ashutosh. Nice question. It is actually compound interest. In case of mutual fund, compound interest is considered. Kevin Morjaria has asked, sir, which interest rate we earn in savings account in a bank, simple or compound? Well, Kevin, it is always simple interest. That also on the average monthly balance. If the banks pay on compound interest basis, banks will have big problem in running their business. Rohit Agarwal from Jaipur, I love and enjoy your class. Thanks, Rohit. G. Kartika from Sivakasi, thank you so much, sir. I can easily understand. Thank you. Naman Jain from Ashok Nagar, it is showing Albert Einstein who developed the rule of 72. I have given you the link in Wikipedia. It is said that the first reference to the rule of 72 was made by Luca Pacioli. Later on, Einstein also arrived at a similar, conclusion. But ultimately, looking at theoretical, perspective and who is the first, it goes to Luca Pacioli, even though both Albert Einstein and Luca Pacioli are great. They have been great and absolutely fabulous in their intellect. Okay, Murli from Chennai. If we put 0 in, he has said about a linear equation. Now you require 2 points to join a linear equation, but how can you get more points? Now say I give an equation here, say x plus 2y equal to say 5. Okay, so x plus 2y equal to 5. Well, you have to use trial and error. For example, in this case, if x is 0, then y is how much? If x is 0, then y has to be equal to 2.5. Okay, if y is 0, then x is 5. But by trial and error, this is Murali's question from Chennai. By trial and error, if you put x is equal to 1 and y equal to 1, if x is 1 and y is 2, then you will see 2 2s are 4 and 1 5. So the straight line x plus 2y equal to 5 will also pass through 1 and 2. x1, y2. Okay. Next question is from Snehadarshini from Chennai. Sir, is TDS applicable for all accounts like savings account or fixed account? TDS provisions you will learn later, section 194, especially TDS with respect to interest. And in banks, if your income is below the taxable limit, you have to submit form 15G, 15H according to your age. And in that case, the bank will not deduct tax. Otherwise, the interest which you earn both on the fixed deposit and on your savings account is taxable. Rahul Kumar from Kolkata, sir, how bank calculates the interest on savings bank? Complicated calculation, Rahul. It is done on average monthly balance basis. Akshat Chuk from Delhi. Sir, if the question mentions, I was talking about the rule of 72. So he has said if the answers are how much the money, how long will it take for the money to double? And if it comes to 7 years and we have two values, 10.41 and 10.28, which one to choose? Please choose the one which is nearest to the answer or the exact answer, right? Don't go for approximations. In the exam, it is better to focus on the correct answer or the nearest answer. In real life, of course, we go by approximations. There, rule of 72, 114 and 144 becomes very handy for us. Tushar Datta from Jharkhand, what is the actual meaning of effective rate of interest, Tushar? I hope you have followed all the sessions and you know that effective rate of interest is the equivalent annual rate of interest which compounded annually if the interest is compounded more than once a year. Simran Kedia, please teach present value. I'm sure, Simran, you have understood now. We have done number of examples from present value. Srimani K from Tamil Nadu, sir, can we round off the answers of the problem or should it be the exact one? Well, I would say it should be the exact one or the nearest or the closest answer. Tanu Tanwar from Faridabad has thanked me for the classes. Thank you, Tanu. Welcome. Kajal from Chandigarh, what is the difference between annuity and annuity immediate and annuity due? So I have already discussed this. Annuity regular, you know, where the payments take place at the end of the year. Annuity due or annuity immediate is where the payments take place beginning of the year, beginning of the period. Gokula Selvan's case I have taken inconsistent examples of equation in Kramer's rule especially. Bharat Kumar from Chennai, is annuity and simple interest the same? No, I have explained it. Utkarsh from Lucknow, he has said, thanks a lot for imparting vivid explanation. Thank you, Utkarsh. Karthik Raj from Chennai, sir, if the number of years given is 4 years, 2 months, then how can it be calculated in future value? Usually this type of questions will not come, but if it comes, we saw one problem here where regarding depreciation, where the number of years came to 5.4. Rare, very rare, but sometimes it comes. But of course, you have to use calculator for that. Manav from Delhi, when a question is silent, do we need to assume it is annuity regular? Yes, Manav, we will assume it's annuity regular. Riya Kumari from Jharkhand, what do you mean by effective rate of interest? I think, Riya, you have followed it and I have done it once again for you today. Effective rate of interest, both the concept as well as the formula. And Latika from Sydney, the question is, she has asked, shall we be asked to prove that a matrix is symmetric and skew symmetric? No. No such proof will come in the exam. You just need to know what is symmetric matrix and skew symmetric, which I have already explained in the last session. So dear friends, we wrap up this session and we talked about the time value of money in the last 3 sessions. We discussed in detail on the simple and the compound interest rate, the effective rate of interest. Then we looked into the annuities, regular annuity and annuity due and annuity immediate. We also looked at sinking fund problems. Thereafter, we moved on to the present value and the future value numericals. And finally, we concluded with the applications today: leasing versus purchasing, capital expenditure, bond valuation, perpetuity, growth in perpetuity, and the compounded annual growth rate. Plus, we did number of problems, and I hope that you are finding the sessions useful. Do send in your comments and your feedback as well as your queries. So I wrap up the session. Now it's already 1 hour extra, but fortunately and thankfully, thanks to your cooperation, we have been able to complete the chapter. We have covered the details from every angle. Still, if there are queries, do send in. Till then, till we meet tomorrow for the session on permutation, take care, practice, and bye for now. Thanks.